Good afternoon, my dear incubatees and the participants here present. This is the Directorate of Entrepreneurship and General Studies, National Open University of Nigeria, Certificate in Entrepreneurship Education. Today, we are going to look at Module 5, titled Financial Planning and Management in Business. I am Dr. Helen B. Inyang. Let's look at the intended learning outcome. The intended learning outcomes are like this. By the end of this module, you'll be able to analyze different sources of credit facilities to make viable decisions. You'll also be able to apply the financial discipline in achieving business success. You'll be able to assess and manage credits as well as capitals. You'll also be able to analyze cost-benefit analysis of a business and be able to look at the inventory management in business. You'll be able to explain and also be able to carry out inventory management. Now, what is the difference between, we are going to look at the different sources of credit. We are going to look at the different sources of credit. But before then, what is credit facility? What is credit facility? What is credit facility? A credit facility is a type of loan made in a business or a corporate finance context. It allows the borrower or it allows the borrowing business to take out money over an extended period of time rather than reapplying for a loan each time it needs money. In essence, a credit facility lets a company take out an umbrella loan for generating capital over an extended period of time. So the various types of credit facilities include revolving loan facilities, committed facilities, letter of credit, and most retail credit accounts. Now we are looking at the different sources of credit facility. We can say that credit facility can be classified into short-term, medium-term, and long-term facilities. And it can also be classified under external and internal. You can source it from external, you can source it from internal. So looking at the chart here, so the internal credit facilities comes from capital invested by the owner, retained profits by the owner, sales of unwanted assets by the owner. And then when you are looking at the external, you see debts and equity. Also, other debts here, we have long-term overdrafts, which includes overdrafts, commercial bills, factoring. Sorry, under debts here, we have short-term, which includes overdrafts, which includes overdrafts, commercial bills, factoring. Then in long term, you have mortgage, debenture, unsecured notes. These are long-term source of finance. Then with equity, this comes under private and public. We have in public here, we have ordinary shares, new issues, rights issues, placement, share purchase plan. So these are the various sources of finance that you can think about. Let's quickly look at the common So let's quickly look at the 10 most common ways to finance your business. This includes savings, personal saving, or ownership forms, or ownership equity. You can save money. Savings can come from their profits, can come from other sources of your business engagement, from your income. And then you can also source money from family and friends, relatives. You get some money from them to establish a business. You can also source money from the bank credits. As under that chart, the credits or equity comes from the debts comes from the bank most cases. And then you can also partner with people. Taking for example, you generate the idea. You are an innovator. You have come in with an idea, but you don't have money to finance your business. Then you can partner with somebody that has the income. So the person now will now give you the money, and then you do your brain work, and then carry out the production or services, and then render to the people. At the end of it, the money or your profit will be shared according to the agreement made at the initial stage. You can also finance your business through money lenders. But I want you to be very careful. There are some money lenders that exploit. When you are going to money lenders, go to the money lenders that will not exploit you. Then you can also finance your business through angel investors. Angel investors here will help you finance your business. There are some people out there looking for organizations out there looking for whom to help, especially they are out there looking at people with a vibrant businesses, and then they can invest in your business. And then at the end of it, you share your profits. You share the income together. As far as for the angels investor, they are out there, they have the money, but some of them do not have what it takes to be creative. What they do is to make sure that they invest on the vibrant business owner or creative ideas. Or you can also call an angel investor equity investors. These are individuals with a lot of money who provide capitals for business startups. You want to start up a business, you don't have what it takes. So these people are only interested in businesses with promising growth potentials. So you are required now to share the ownership and then control of the company with an angel investors. They will help you to finance your business. Then another one is venture capitalists. When we talked about venture capitalists, these are a group of people or wealthy individuals, government-assisted sources, or major financial institutions who have a dedicated pool of capital and makes it available for expansion of businesses with great profit potentials. These people hardly invest in new businesses unless there is a significant profit potential which can be identified and measured. Venture capitalists are those type of people that they will look at the business that is vibrant and promising, that knows that if they invest in this business, they will be able to make it. They now pool their capital, their resources together in order to expand. That is, you have already started the business, but you don't have all what it takes to expand. Then the venture capitalists will now come in to help you expand this business for you. Now, sourcing from fund, that is from a venture capitalist, is a good idea because you get money that does not have to be repaid. You won't repay because they will now be part of the stakeholder of the company, of their business, shareholders. So sometimes bank may be more willing to extend credit for business because the money invested by the venture capitalized is equity. It goes to the note that it is good to note that the venture capitalists may demand control over your business. You have to know this. They will demand control over your business. You can also source funds from your customers. You can source funds from your customers. So this source of fund is only visible if you have consistently built an excellent reputation in your field of business. If you have not built that reputation in your field of business, there is no way you'll be able to source for funds from them. Your customer can help you finance and partially finance the business by making advance payments for you. They can finance or sometimes do it partially. They will give you advance payment, or some of them, if you have a good reputation with them, they will give you all the money, what it takes for you to do the business, to carry out the business. You can equally encourage each cash payment instead of giving the customers goods a credit on credits. So you can also generate funds by granting cash discounts to customers who make early payments. Yes, pay me. As you pay, I will produce and give it to you. And then at the end of it, you discount for them. Then trade credits and vendor credits. And also, this is another source of fund. Trade credit and vendor credit is another source of funds for financing your business. Here, by negotiating a deal with your suppliers, payments for raw materials or goods supply may be deferred in future. You get your supplier will give you the raw materials and then to be paid in future after production. This enables you to use the income generated from the sales of goods manufactured to pay up your debts instead of borrowing. You collect raw materials from your suppliers and then with intention you pay them after production. Then another source of finance is grants. Here, grants are non-repairable funds bestowed by either government or private non-profit organizations or foundations, or you call it grant makers. So an eligible recipient, that is the grantee, eligible recipient, because it's not everybody can be given grants. So computation for grants is usually heavy, but you can obtain grants of your enterprise if your enterprise will have a positive social impact. I mean, those that are really dealing on the social entrepreneurs are the ones that always get grants. And when you socially impact, and you know that your services or produce will be of benefit to the society, that is when you'll be able to obtain grants. Grants may not necessarily come in form of money, but it can also come in the form of fixed assets. Either the government or the non-governmental organization can give you a fixed asset, which will help you, maybe in form of machineries or any other thing that will help you to be able to carry out your production or render your services effectively. Then what is financial discipline? What is financial discipline? Let's quickly look at what financial discipline is. Financial discipline is in simple words, is just how well you can manage your expenses and manage to save as well as keeping your goal in mind. It is all about making good use of the money that you have earned and invested it wisely for the company. You earn money and then you reinvest this money. You don't spend anyhow. It is done to reduce the future problem and prevent risks. Financial discipline is when you are in control of money you are spending in your business. You control, you know how much, what you want to spend. You don't exceed more than what you want to spend. And you spend on the necessity, not on anything. That is all about financial discipline. Then, having looked at the financial discipline, let's quickly look at the 5 matrices for financial discipline in life. The mantras for financial discipline in life, we have this. The first thing you need to do is to set up your goal. Goal setting. And it is done one step at a time. What are your goals? You set up your goal, and it is done one at a time. Set up your goal, and what do you want to achieve? And then you try to make sure that you achieve the goal setting. As to survive in that business, you must make sure that you are a goal setter. You set up a goal, and the goal you are setting is one at a time. One at a time. This is, and make sure that you achieve it. Set up a goal and achieve it, and then go to the next one. And then, having done that, the next thing about financial discipline in life is save your surplus. That is a mistake most people make. When they make profit, exceptionally profit, instead of them to save that surplus money for a rainy day, they will spend it on irrelevant things. In a situation whereby there is no money, like what we are facing now. This cash swap have really affected a lot of businessmen and women in Nigeria today. So what they do now, you do. Whenever you have surplus money, cash flow, a lot of you save it for a rainy day. So that in a situation where there is need and you cannot, the money is not handy, you now go back to what you save and use it to offset your expenses or to meet your obligations. The next one you should do, the fifth one is repurpose your assets. There are some assets in your enterprise or in your company that you think those assets are no longer functionable for that kind of business. You can now use it for another thing. You can use that machineries or an asset for another enterprise or a soft enterprise, still in the same organization. Taking, for example, you are an entrepreneur that maybe goes into that rear animals. And then at a point you used to compound feed for your animals. And at a certain stage in time, you now decided that you're no longer involved in rearing of animals. Instead of that machine to lie wasted, why don't you now produce the feed and then sell it off to the animal farmers? Or you have a particular warehouse where you used to maybe store agricultural produce. And a time comes that you no longer want to continue that business. You can convert that warehouse to another production unit, to another purpose, for another purpose, to do other things. Then the last but not the least matrix here is diversification. You cannot just put your egg all in one basket. You need to diversify. You need to engage in more than one enterprise. Why are you doing this? So that if one fell, then you fall back to the other one. Now, the next thing we are going to look at is overview of the concepts of financial planning and management. Everything centers here on you, financial planning, how you'll be able to manage. How much you look at, how much do you have? When you look at how much do you have? And what are those people you want to bring in? As looking at the overview of financial management. How much do you have as far as financial control is concerned? You look at it, how much do you have? So everyone you see, everything, the concept is you. Everyone is financially unique. You can plan, and financially planning needs to be tailored to you. You are financially unique. How your assets have been accumulated. How do you accumulate your assets? where they are held and what you want to do with them is a unique to you. Your objectives, your attitude, your preference, and time scale will also be unique to you. The next concept of financial management or planning is how much. How much? How much money do you need? Do you have enough of this money? So knowing the amount of assets you will need to meet your requirement, your objectives and aspiration over the course of your lifetime. And after you have known, enable you to understand where you are currently in relation to this and how to plan accordingly. You must put all these things in mind. The third concept is time and expertise. Time and expertise. How much time do you want to spend managing your assets? And are they currently organized to reflect this? You know, managing your assets or wealth takes time. Sometimes there are some businesses you want to embark on and it takes a longer time. So it takes time. So knowledge and expertise also. How much time will you spend or will you use to determine by where your assets are held and how involved you are and want to be in the management? If you do not manage an asset yourself, then you paid somebody. You pay someone else to reduce the time you should spend and also to try and achieve a better outcome. And paying somebody must be somebody that is expert in that field. You don't just go and pay a novice to help you manage your assets. You don't do that. Pay somebody that is efficient and somebody that you are sure will deliver to you. The concepts 4. Concepts 4 is the tax. Here, tax understanding, how your various assets are taxed. You must have that knowledge, that understanding. Whether this could be better organized to reduce the tax you pay, at least you assess your assets. Then tax can have a significant impact on the value and longevity of your assets over time. So by organizing this within mainstream tax allowance, you can minimize the amounts of tax you pay and protect the value of your assets. That means any assets you have, every year you must have something like annual depreciation charges. Your assets cannot value, maybe your asset is supposed to last for about a period of 10 years. Then it can't be the same. The first year, at least you pay a complete tax. But the second year, you must calculate your depreciation rates. Keep it aside before you think of payment of assets for that. Because if you don't do that, you end up paying, your tax will be over what you're supposed to pay. Concept 5 is an asset. It's an asset. In what form are the assets that makes up your wealth held? And does this reflect your needs, your attitudes, and your preference? How your assets are held and managed will determine the cost to you. That means you need a very good manager that will be able, or you as yourself will know how to manage your assets well. So the tax you paid, the level of risk or volatility you experience, and the returns you achieve will depend on how you manage your assets. Every asset you own will have its own profile. It will have its own profile. One of the profiles is maintenance, risks and returns, tax accrued to the assets, liquidity, and growth versus income. So understanding the blend of your assets and their characteristics will help you make the right decision for your business. The last but not the least is the second to the last is concept 6. That is protect your business. How are you financially, or how are your financial plan impacted by your premature demise or illness? That is very important. If you don't plan, some people, if you don't plan, that means if you don't have a plan, you plan to fail in life. So by the time before you start your business, look at all these things. How am I going to plan my finance? If anything happens, the risks involved, anything unforeseen circumstances happens now, how will my company survive? You must plan. You must be a good financial planner. Or if you cannot, you employ an expert to help you plan well. So you are at most risk during the period you are accumulating the level of assets you need to provide for financial plans of you and your family. These risks can generally be incurred or insured to protect your financial plans. That's why so many people maybe go into insurance company to insure their businesses, so that in case some of them do life insurance, in case of the unforeseen circumstances, then the insurance company will now come to your aid without wish. That means you pay a certain amount of money called premium to the insurance company. It may be on monthly basis or yearly basis. So by the time, in case of any risks or unforeseen circumstances, they will come to your aid at this point in time. The last but not the least is concept 7. Keep on track. Keep on track. Managing your finance, assets, and financial planning is a continual process that takes into account changes in your life and the world around you. That means you must be conversant in the changes around you. We are in a dynamic, ever-changing and dynamic world. You must also change your style of business operation based on the changing environment or the trend of the event. Now, what is financial planning? That is, in a nutshell, we can sum up financial planning in this way. Sources of funds, that's financial resources, plus utilization of funds, financial techniques. This will give you financial planning. You must know where you source your funds. You don't get your funds where you will pay exceptionally interest. And then by the time you source this fund, you get the fund, you must make sure that you'll be able to utilize these funds using the financial techniques. You must be financially knowledgeable on how to manage the funds. You can see we have summed it up. What is financial planning? Financial planning is an ongoing process to help you make logical decisions about money that can help you achieve your financial goals in life. I've said this. So here, we need to focus on two key words. That is the process and ongoing process. The process, a process, an ongoing process, which is further explained. Let's look at the explanation below. Here, financial planning, these are still the definitions of financial planning. It's a process of estimating capital requirement and determining its computation. It is the process of framing financial policies in relation to procurement, investment, and administration of funds of an enterprise. Financial planning is a collaborative processes that help minimize a client's potential for meeting life goals through financial advice that integrates relevant elements of the client's personnel and financial circumstances. Why do you need financial planning? That's another question. Why do you need financial planning? What are the reasons you need financial planning? So let's see these reasons. The needs for financial planning is one, allow you to reach your specific goals without having to compromise your standards of living. If you are a prudent in spending, if you are a good financial manager, you meet your financial goals. You'll be able to carry out all what it takes in your business. You know how to minimize, use the minimum resources to achieve a maximum output. That's a good financial manager. And as such, you will not mortgage your living standards of your business. You eat well, do other things, save money, and meet your obligations, your financial family obligations. Financial planning will help you assess your risk profile and develop appropriate assets allocation and appropriate assets allocation strategies. You know, it will help you. You look at, there are some people, in fact, if you are not a good manager, financial manager, you'll not be able to detect when you are machines, if you are into production enterprise, when your machines you use started undergoing wear and tear. Some people lack that maintenance culture. So you continue using it, even when you hear that some certain things have started, and then you not think of going to repair it on time. You allow until when everything collapses. You now start running helter-skelter to look for money to repair it. One at a time. It is one at a time. You look at your assets. There is no asset that will last forever. Assets undergo wear and tear. Even when it has to do with building, you maintain the building. Change the roof as at when due. and other things as at when due. You don't allow everything to collapse before you start looking for money because it will cost you so much, one at a time. Financial planning provides directions and meaning to all your financial decisions, leading to more discipline, choice in life. That's all about financial planning. It helps you. It makes you to be most disciplined in terms of spending. You don't spend unnecessarily. You spend when the need arise. You spend on something important. Instead of spending, you now either you save your surplus or you reinvest it to something that will yield profit for you in future. Also, financial plannings help you to plan your investment, retirement, taxes, children's education, children marriages, properties, and so on. It won't cut you unawares. If you're a good financial planner, you know that you will not work for life. A time is coming that old age will set in, and then you will not be able to do what you used to. If you did not plan well, you may not be able to employ people to take up those things that you used to do. Or you may not be able to hand over your assets to your successors. That's how your children. And if anything happens in their family, you may not be able to do if you are not a good financial planner. Then let's quickly look at objectives of financial planning. 6 objectives of financial planning. These are, it will help you, financial planning, help you to determine current financial status, will help you to determine your current financial status, and then make the redress. What are the state of your financial condition at this moment? That has to do with evaluation, inventory taking, and so on. So financial planning will also help you to determine your capital requirements. How much does your capital require? Or how much do you need for one thing or the other? It will also help you in framing financial policies. You must have a policy. There are some people that have very good policies as far as finance is concerned. I don't spend. There are some people that will not dip if they have kept money for a particular thing. They can't use it for any other thing. They must make sure that money is meant for that thing. No matter what happens, they will prefer to source money from other areas to meet their obligations, not their business money. Financial planning will also help you in risk management strategies. It will help you to strategize how to manage risks. Because no businessman, no entrepreneur will run away from risks. Risk is something that is inevitable. You can't avoid it. It must surely come in one way or the other as far as business is concerned, especially those in agricultural production. You know, agriculture is characterized by a lot of risks. You can't do without. You must be able to strategize ways of managing it through your financial planning. Financial planning will also help you to determine portfolio structure. What structure do you need? What are they on ground? What are the additional structure that we need to make us expand our business, or make us continue in our business, or make us to be able to maximize our output? Also, financial planning will help you, that will help you to make maximum use of the scarce resources. Like in economics, human wants are unlimited, but the resources to satisfy these wants are limited. They are scarce. So any business resources are scarce. So how will you be able to make maximum use of the scarce resources available in order to maximize your output or maximize your services rendered to your customers or consumers? Then the next thing we are going to talk about here is importance of financial planning. The importance are, as outlined here, adequate funds have to be ensured. You ensure adequate funds. Financial planning helps in ensuring reasonable balance between outflow and inflow of funds so that stability is maintained. You don't, as the money comes in, you don't spend it that way. Because if you spend it the way the money comes in, you may end up spending your capital. Financial planning ensures that supplier of funds are easily investing in companies which exercise financial planning. Anybody that wants to supply funds to you or invest in your company will look at your records if you are the type that have financial planning, that is financially disciplined. Financial planning helps in making growth and expansion programs, which help in long-run survival of the company. Financial planning reduces uncertainties with regards to changing market trends, which can be faced easily through enough funds. Financial planning helps in reducing uncertainty as well. It helps in reducing uncertainty. Seven steps in financial planning. You must understand your client. That's number one. And your client's personal, and then financial circumstances. You must understand. Identify selected goals. What are your selected the goals? You must identify certain goals that you want to achieve as far as your business or enterprise is concerned. Then, having identified this, you analyze the client's current course of action and potential alternative course of action. What are their needs? What do they need? You must consider this, and then plan towards that. If you need more value added, you add the value. If there are certain things you need to reduce in your product, you do that. just to make sure that you satisfied your client. Developing the financial planning recommendation. You must develop that, what is expected. Then the fifth one is presenting financial planning recommendation. You develop it and then present it. This is what entails in my company. Then the sixth step is implementing the financial planning recommendations. You have to put it into practice. The seventh but not the last, or the last but not the least is monitoring progress and updating. Monitor your financial progress and update it. Financial management, we'll look at financial management, meaning, scope, and objectives, as well as functions. The meaning of financial management. We have finished with the financial planning, down the financial management. Financial management means planning, organizing, directing, and controlling the financial activities, such as procurement and utilization of funds of the enterprise. It means applying general management principles to financial resources of the enterprise. Now, let's look at the scope of financial management. Financial management involves financing decision, investment decision, and dividends decision. These are the scopes. What are your decisions? Because the decision you make will make you succeed in business or you fail in business. Your investment decision too can make you have a breakthrough or you become stagnant. Your dividends decision as well can also make you to be successful or it can ruin you. These are the scopes of financial management. Then importance of financial management. It promotes business, number one. Number two, help you in making sound financial decisions. As financial, it helps you to make proper use and allocation of funds. The fourth one is help in improving profitability through financial controls. 5, it increases the wealth of the nation and investors. A good company with financial management, good financial management will increase the wealth of the nation as well as the investors. Because by the time you are good in financial management, you'll be able to make more profits. And that will also help in increasing the economic, helping in economic growth of the nation. The sixth one, a good financial planning and successful financial planning and successful promotion of the enterprise is help in promotion of an enterprise. An enterprise that is good in financial management. So many people want to invest in such business. Then financial management also help in acquisition of funds, as will be able to enable you to acquire funds, and when required to carry out any project at a very minimum cost. You can obtain loans from the bank if you are a good financial manager. They'll say, no, he will pay, let's give him as much as what he wants at a very reduced interest rate. Number 8, financial management is simple text that you can edit. You can change anything. Financial management will help you You can help yourself. You can go through it. You can look at it. You can say, okay, this is where I make mistake. This is where I will fall back to. This is what I can do. Implementing and monitoring financial planning. How do you do that? So implementing the plan first. The financial planning. Financial plan is useful to the client only if R is put in action. The resources, the restriction, if they are all put in action, if the resources available is put in action, and you now will be able to utilize it, the available resources, and then come up with a maximum output. Financial planners to assist the client or manage this process is defined as defined in the engagement arrangement. That is all. How to mentor them, you help them. Then now monitoring the plan. The financial planner and the client should conduct periodic review as at when due. Change in personal circumstances. That's they conduct this review when there is change in personal circumstances, changing in tax as well, tax law. And also they will also, when there is changing in life circumstances, as well as they also make periodic adjustment or recommendation as necessary. That's how the financial, how to implement and also how it will be monitored. Types of financial statement. There are so many different types of financial statement. We have here statement of income. That's one of the financial statement. We have statement of equity. So these are the different types of financial statement. Statement of change of inequity, statement of cash flow, statement of financial positions. Here you have things like a balance sheet and others. All these ones, you'll be able to know how your cash comes in and goes out. The equities as well. So these are the different types of financial statement. Let's quickly look at, or because of time, risk and return in financial management. These are the returns and this is the risk. One here is risk-free bound. The first is risk-free bound. Here is under the stage 2 is investment grade bounds. And the first one is, the third one is high yield bounds. Yeah, when you get to this top, you are making more. When the risks, the higher you take, the higher risks you take, the higher are the high profit, the maximum output you make or profits you make. In stage 1, you know, these are the people that do not really want to consider about risks. They always run away from. At this point in time, you may not be able to make heads well. In stage 2 is the investment grade bonds. That is where you are making investments, but you may not really come out with so much. Here, at least your investment has started yielding something. Then you get to where you have equity, you have assets, you make gains. Then here you also have private assets. You can take risks using all those things. Sorry, the network is giving me some issues here. So here, looking at this, stage 1, 2, 3, 4, and 5. Under here, you see that in general, like I said, higher investment returns can only be guaranteed by taking on the higher investment risks. If you take a low investment risk, you may not make much returns. Taking, for example, by diversifying portfolio of investment assets, you now compare the returns and the high risks. I said before the network interruption from the network, I said that relationship between the risk return relationship. If you take high risks, you also have higher returns. Let's take, for example, if you diversify a portfolio of investment on assets, then a comparable return can be generated with less risks than an undiversified investment portfolio. That's why it's always good. That's one way of mitigating risks is diversification. That is, there is a limit to effectiveness of diversification as well also. Also, the risk return trade. Risk return trade-off is also a foundational investment principle. So there are many different types of investment and asset classes, such as money market security, bonds, and others that you can also take in order to be able to minimize the rate of risks that you can take. You can't. But one thing is sure is that All these classes you see here, they come with varying level of investment risks. Having invest with different risk return portfolio help you meet the different risk appetite of various investor groups. So looking at this, the graphs here, the asset class 1 risk-free bonds are issued by government. Government are the one that issued risk-free bond, and in most cases are considered risk-free since a government can print money to pay off its debt. Yes, risk-free. Because of this, risk-free bond are safer assets, safety asset, and have the lowest investment return. That's what I told you. The lower the risks, the lower the investment return. So moving up to the risk return spectrum, you can see that each asset class gets riskier when you get to risk 2. Then the potential investment returns associated with each asset class also increase. By the time it gets riskier and the more returns too. So asset class 5 is a private equity, which involves investment in private companies that are not publicly traded on exchange. These investments are typically riskier than the public equities and include additional risks such as liquidity risks. This is because of additional risks. Private equity also offers investors the highest potential investment returns. So that is, you can see here, the higher it goes, the riskier it's become, and also the higher the investment, the returns on investment as well. So managing and controlling cash flow. How do you go about this? You can manage this through this. Cash flow. Then what is cash flow and how can you effectively manage it? Cash flow is a lifeblood of your business. It's all about, it's a lifeblood of your business. Cash flow is a measurement of the amount of cash that comes into and out of your business in a particular period. That's income and expenditure. Then how do you manage the cash flow? There are 7 steps to improve your cash flow management as well. 1, stay on the top of your bookkeeping. Record keeping is very important. Make sure that you record every transaction you make and know how much comes in and how much goes out. Very, very important. You know how much comes in and how much goes out, without which you will not be able to manage your cash flow effectively. Number 2, generate cash flow statement. If you have an accountant, they can do this for you. Or you too, you can go and learn. Or you can use software to calculate it, to do, using a spreadsheet. You can use your analysis with cash flow projection to see how your decisions are impacting your future financial health. The next thing is analyze your cash flow. How do you go about this? Take the information from your cash flow statement and use it to understand how money is moving through your business and how money is also coming in and going out. Figure out whether you need to increase cash flow. The next thing, you must figure out whether you need to increase the cash flow, relying on your credit card or a line of credits to make ends meet. Then cut your spending. That's another thing. You must cut your spending where you need to. When you see that much money is going out and then at the end of it, you are almost eating your capital, you must cut your expenditure. Overspending can result from either over covering unnecessary expenses, paying for expenses at unstrategic time. You don't do that. You must, if you're a good manager, you know when to spend money. Cut overspending to increase your cash flow. Then speed up your accounts receivable. Whether you are waiting on invoice payments from clients or deposit from payment processors. The faster you get money in your pockets, the more cash flow you have. That's the thing. So in most cases, it's good that you don't keep money with you, because if you have the cash inflow always, and this is how much is coming, that's how you spend. It's better sometimes you save or you reinvest it. Rinse and repeat. Make analysis your statement in a regular part of your back office routine. The more you do it, the better you get at spotting opportunities to increase your cash flow. And they then also will be able to minimize shortage in it. Inventory management. How do you manage? In inventory management, we look at why, who, what, where, when. So all these are the key things. Who bought or supply the goods? In inventory management, you know the inputs you bring in, you know what you sell out, and who were purchased, and also who supplies you, who bought your goods from you, and who supplies you must also be in inventory management. Okay, taking for example, you are into poultry production. Now, you have been able to purchase day-old birds, chicks. Then what you need to do now, you have to put in on record. Day-old bird was supplied by so-so and so-so person at what rate and how many. And then now you want to sell eggs. The eggs was sold to so-so and so-so person. You must keep records. You must, so that you'll be able to, when you are looking at your inventory, you'll be able to track on what is wrong. Then the next thing is what products are you involved in? You must spell it out. And where is the location? Where do you intend to locate your business? You must know where you are doing this. When? Who is looking for this business? Who is looking for your products? Who is requiring for your products? You must know the location. So that, why do you need to know this location? So that you will be able to deliver it as at when due, on time. The next thing you look at, when do these people need these products? Because you know their location, you know when they need it, needs the products, so that you'll be able to deliver on time, or you'll be able to receive or deliver on time. Why? Why did they, why did the transaction happen? You know, you need this. Why did it happen? You must give a purpose. Either they want to use it for occasion or they want to do this and what and what. So these are how you be able to manage your inventory. Supplies this to this for this purpose. Then the next one is benefits. For time, because we don't really have much time again. The benefits, 5 benefits of inventory management. Keep tracks on your inventory and offer centralized view of stocks. Control your costs by making stock reports for analysis of your inventory. Improve your delivery by managing stock out and meeting customers' expenditure. Manage planning and forecasting by analyzing data threads. Then the 5th one is reduce the time for managing inventory by keeping records in place. Make sure that you are a very good record keeper. Keep your records, make sure that they are intact. Then cost-benefit analysis. Cost-benefit analysis. What do you mean by cost-benefit analysis? That's a question. What do you mean by cost-benefit analysis? A cost-benefit analysis is a process of comparing projects or estimates costs and benefits associated with a project decision to determine whether it makes sense from the business perspective. Generally speaking, cost-benefit analysis involves tallying up all costs of projects or decision and subtracting that amount from the total project benefit of the project decisions. That is all about cost-benefit analysis. Now, how do you assign monetary values to activities under costs and benefits, including benefits, and compare their monetary values to costs? Does the benefit justify the cost? How do you assign this? So how to assign values? You must also look at what did you purchase? How much, taking for example, how much is your income? What did you sell? And other things. How much did you sell? And how to do this? You look at the indirect costs. How to identify costs and benefits. Look at the indirect costs. What are your indirect costs? You look at the indirect costs and benefits. There are some benefits that are not direct benefits. There are some benefits that are not direct benefits. So in identifying costs and benefits, you look at the first thing, indirect costs. These are typically fixed expenses. These are indirect, which you may not compute if added to what your expenses, such as rent. The fixed expenses as utilities and rent that contributes to overhead of conducting business. Then tangible, intangible costs. These are, you look at this one, there are current and future costs that are difficult to measure and quantify. Examples of this include decrease in productivity level, that is intangible costs, while new benefit process to roll out. These are intangible costs. So that is how we identify them. Then opportunities too, opportunity costs. This refers to lost benefits or opportunities that arise when business pursues one product or strategies over the other. Then looking at the direct costs, increased revenue and sales generated from new products. So looking at some benefits we have direct benefits, increase in revenues as a result of sales and products and of new products. Indirect benefits, these are increased customers' interest in their business or brand. Then we have intangible benefits, improved employee morale and competitive. That's competitive benefits also, being the best movie within the industry and so on. Steps to do the cost and benefit. What are the steps? Or does this cost? You also ask your question, does the benefit justify the cost? If the benefit does not justify the cost, that means that business is not a worthwhile venture. So how do you, the steps to do a cost and benefits? The first thing you need to do, brainstorm cost and benefits. You look at, list down, I like the cost. And then you list down the benefits and look at them. Look at the cost. Will it justify the benefits? Will the cost justify the benefits? If it is not, don't give it a thought. Then assign monetary values to the cost. And also assign monetary values to the benefits. So that by the time you do this and compare them, compare the cost and benefits. If the cost if the cost exceeds the benefits, that business is not a worthwhile venture. You don't need to go into it. Also, when you also look at the payback period, this is the time to take for benefits to repair costs. Now, when you look at the benefits now, the benefit exceeds the cost. That's your pay time period. I have invested so much, my labor, my money, everything, all the resources in it. And this is how much I have been able to obtain. So this is what we have been able to do. Thank you very much for listening. See you in live class section. Please, I would like you to listen to these videos, to this video, and then watch them carefully so that by the time we come, we have an interactive class. Thank you very much. See you in live class section. Bye for now.